Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Wood, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. China's whole economy is on the verge of collapsing, causing the world's largest recession. China's recent economic statistics have revealed the country's serious shortcomings. China's Communist Party is attempting to preserve the economy, but the truth has already been revealed. Cathie Wood handles nearly $20 billion and has immediately identified the world's impending suffering. For the first time in over 5 decades, economists see that the United States' GDP growth is exceeding that of China's. So what's the true story in China? In this video, we'll discuss China's current situation, as well as the alarming evidence pointing out to the country's impending collapse. China's economy began to open up in 1978, and the country enjoyed tremendous development. China's GDP increased at a rate of around 10% each year on average. This resulted in significant prosperity for the Chinese people. Over 800 million people were lifted out of poverty. Healthcare has vastly improved, education has become a priority, and technological advancement has accelerated. China's unprecedented prosperity has transformed the country into a manufacturing powerhouse revered by economists worldwide. However, as we all know, there's no such thing as a free lunch. The expanding liabilities of China were the driving force for its unprecedented development. Those that took out loans saw their net worth increase quickly when the economy was booming. The cycle acted as a positive feedback loop, causing China's growth to be exponential. This model has been effective for many years, but China's debt has reached an unsustainable level. China's government debt to GDP ratio has risen almost 66% as a result of decades of rapid growth. The entire public debt in China has likewise increased to nearly 300% of GDP. This is about 60% higher than the global debt to GDP ratio and nearly double the non-financial corporation debt to GDP ratio in the United States. Such a vast number of liabilities is clearly unsustainable, as China's recent problems indicate. China has been seeking to put into action what is known as the Zero-COVID policy. The Zero-COVID policy sets a straightforward goal for China's government: zero COVID cases. The only way to come close to achieving this goal is to impose strict laws with serious economic consequences. Due to tight COVID laws, banks and economists throughout the world have consistently lowered their GDP forecast for China. More significantly, China's crackdown on over-leveraged firms may trigger the polar opposite of the positive feedback cycle we previously discussed: a negative feedback loop. The economy slows as a result of people defaulting on their loans. Real estate prices are the pinnacle of unusual prosperity. Increasing property prices have resulted in a disproportionate percentage of capital appreciation for speculators. Xi is taking steps to combat this by imposing additional property taxes. The 3 red lines set a limit on how much debt real estate developers can take on. All of these initiatives have resulted in a rapid decline in home prices. The number of new house sales is similarly on the decline. In 23 major Chinese cities, new home sales were down by 33% in early May 2022. The Chinese government is aware of the company's imminent catastrophe and collapse, and so is doing everything possible to prevent it. While the US Federal Reserve raises interest rates, China's government lowers interest rates in order to save its economy. The prime rate of household and corporate loans in China is now 3.7%. This number is only anticipated to decrease in the future. The country's 5-year loan prime rate was recently slashed by a greater amount in 2019. Several investors regard this crisis as an isolated isolated event that will have little impact on other countries. Conversely, Chinese economic crash might drive the entire world into recession. The US Federal Reserve is hiking interest rates, boosting the dollar's purchasing power. This has a direct impact on the Chinese yuan's value against the US dollar. China's collapsing currency will result in a significant drop in purchasing power, while the Chinese economy is already crashing.
The Fed is really focused on the US, but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the US in isolation. We've already had 1 quarter of negative GDP, which most people brushed aside saying, oh, that's a fluke. And, I think that was a real number, and we should not dismiss it. So agree with you totally, Nancy.
In 2021, China accounted for more than 18% of the global GDP. As a result, a sudden collapse in China's economy would weaken the global economy. Additionally, Europe's economic development is slowing, so now we have a terrifying situation. Cathie compared rising interest rates by the Federal Reserve to playing with fire because it could intensify international crisis. For the first time since 2019, the US bond curve inverted, signaling the possibility of a recession. When the yield on a 10-year Treasury bond is lower than the yield on a 2-year Treasury bond, the yield curve is inverted. When the interest rate for a shorter period of time is higher than the interest rate for a longer period of time, the near-term risk is higher than the long-term risk. Bond investors, to put it another way, are anticipating a great deal of pain. Most of the time, an inverted yield curve precedes a recession. Europe and China are in difficult straits. The Fed seems to be playing with fire. International economies are now extremely vulnerable, and a collapse in the US economy would send every other economy into uncontrollable turmoil.
Europe's probably in recession. China is, if we're looking at the micro numbers, China's very weak, very, very weak. And so everything's riding on the U.S. So the supply shocks, I think, are hurting purchasing power, as I said, in the U.S., could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. And I think a lot of what we're seeing right now is a function of supply chain and supply shocks. Very cyclical as well. And I think we'll see the other side of that.
The last global recession occurred in 2008, and it affected many countries. The 2008 recession, however, was not the same scale as our approaching crisis. During the global recession of 2008, China's GDP was still increasing in double digits. The economies of the rest of Asia, Australia, and Africa did not suffer significant declines. Unlike 2008, the majority of Asia, Australia, South Africa, Europe, and America really suffered. I've already shown several graphs about China's economy. However, those figures could be fraudulent. China has the tendency of fabricating economic data to hide economic disasters and inflate growth. Several cities in China have admitted to falsifying economic figures. Due to fake additions, a northern Chinese industrial city named Baotou publicly changed its economic report. Another city called the Chinese Manhattan overstated its income by 33% in 2016. This type of misleading reporting could indicate that China is already in a recession, but we're just unaware of it. Cathie thinks that if we saw the real data in China, the property sector would have even more huge sales drops. In the short term, she believes this will lead to reduced oil prices.
I'm beginning to think that substitution, as well as a recession in Europe, a significant slowdown in China, I think if we saw the real numbers there, we'd probably be seeing more declines, given how much they've hit their property sector and are bearing down on the economy generally from a regulatory point of view. So we think that demand is falling, and would not be surprised at the end of the day to learn that 130 was the peak. course, anything's possible now, given the kind of shocks we've been through.
So with all this knowledge, how can investors prepare their portfolios to weather the storm? Holding cash is one simple strategy to keep your money afloat, but inflation will eat away at your capital. Investing in other countries is likewise not a good choice. With Asia and Europe both struggling, investing in the US market is one method to protect your wealth in the coming months. Although it may appear contradictory, the US financial markets remain in the strongest position among international markets. Despite the fact that the US dollar is undergoing severe inflation, it remains quite robust. The dollar index measures the dollar's strength against other currencies. Although there is massive inflation, this index has been on the rise for the past year. Although a big slowdown in inflation could lead to gold prices falling, investing in gold could be a great hedge. Just remember that all assets have disadvantages. Diversification of the best assets would be the best solution for minimizing volatility while maintaining positive returns in this situation. 25% in cash, 5% in Bitcoin, 5% in gold, 40% in ETFs, and 25% in individual stocks may be an example of diversification. While such a portfolio may not produce the highest returns, you will still have enough money to purchase the dip while accumulating long-term returns.
The dollar's moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the US just seems like a safer place to be right now.
Investing in public growth stocks could be quite profitable if you're willing to take on more risk in exchange for greater rewards. There are many venture capitalists that become extremely positive about public growth stocks. We are all aware that public growth stocks have plummeted, with ARK Invest as the focus of the attention. This has created a multitude of opportunities for 10 times or even 20 times returns in the coming years. Public growth stocks are incredibly volatile, so invest only if you're willing to see your portfolio fall in value in the short term. And there you have it. You can share your thoughts on China's approaching recession in the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.